how IUL can become cheaper as you get older. In this educational video, I'm going to address why my life insurance, Indexed Universal Life, doesn't cost me money. It doesn't cost me anything. Get ready, you're going to be blown away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades. And if you've watched very many of my videos on this channel, my favorite financial instrument that allows me and my clients to accumulate money totally income tax free and then be able to turn on tax-free income from age 65, let's say, even to age 120 without outliving their money. And at the end of the day, when they die, anything left in there blossoms and transfers tax-free. That is only accomplished by using a properly structured, maximum funded indexed insurance contract. Nothing else can accomplish that to the degree that IUL can when it's structured correctly. And I have many videos that explain why it knocks the socks off of IRAs or 401ks, and it far outperforms whole life insurance. For the same amount of money and the same amount of income, a whole life policy will crash and burn, okay? And so what I like to do is explain what I mean by properly structured and maximum funded so that you can become self-insured. Now, there's a lot of agents that do not understand this concept, including whole life insurance agents and many even universal life insurance agents. So self-insurance means that you want your cash inside of the insurance policy to equal and exceed the original death benefit in as many years, as few of years as possible, so that the cost of insurance basically is nothing or very, very small. And a lot of agents, they don't understand this. They say, oh, universal life will implode. It'll crash and burn when you turn 65 and 70 and 75 years old. And I'm going, why? Because years ago, the cost of the insurance, my cash value exceeded the death benefit. Why do I need your guarantees with whole life that keep the whole life death benefit in force if you live to be 100 or 120 when my cash values in an IUL equaled or exceeded the death benefit within 12 years or 17 years? Why do I need to worry about guaranteeing a death benefit for 50 or 60 years when I already became self-insured within 12 years? So let me explain what I'm talking about here, okay? So many times I've used this metaphor of a bucket to talk about what indexed universal life is. So this is a repository where you're going to put money. With an IUL policy, the objective is primarily for living benefits and to create tax-free income, not death benefit. And so if I had somebody come to me that was a male age 60, okay? If a male age 60 comes to me and they want to reposition $500,000. Now, this has happened many, many times. It could be $1 million, it could be $10 million, it could be $100,000. I just want to use $500,000 because it's a nice round number that I use a lot of times. And I've had many, many people who came to me and said, Doug, I have a couple of $100,000 net after tax. I want to roll out of my IRAs or 401ks that's in that volatile market. I'm sick and tired of that roller coaster in the market. And I realize I'm not going to be in a lower tax bracket. And so I want to reposition $200,000 out of my IRAs or 401ks over the next 5 years to not force myself into a higher bracket. That's called a strategic rollout. So $200,000 is going to come out of, let's say, their IRAs or 401ks in a strategic rollout. They may say, I have this rental home or this duplex, and it's like an albatross around my neck. I hate being a landlord, taking out the trash, fixing toilets, evicting tenants. I want out. And so I have $200,000 and I'm going to net when I sell that. I want a place to put that $200,000. Okay, so now I have $400,000. Oh, and I also have another $100,000 that I've been sitting around in this volatile economy, and it's just sitting in a underperforming or non-performing bank account or credit union, rolling upstream at the rate of 1% interest, 1 mile an hour. And I know the current inflation is coming down at 3, 4, 5, 6, 7. I'm going backwards. I need to increase the liquidity rate of return on that. I go, okay. So that equals $500,000. So people come to me and they want to find a place where they can deposit $500,000 to have it grow as fast as possible to generate income. So let's say at age 60, they say, I want this to grow to enough so that at age 70 or 72, that this has grown to at least $1 million and that I can generate $100,000 a year of tax-free income. I want a 10% payout without depleting principal. And I go, I can do it. I've done it many, many times. So 500,000, I cannot put all that in all at once because of the TAMRA tax citation. If I want to make sure I can take money out tax-free, I can only put in about 100 to 125,000 a year the first year. But the first day of the second year, I can put in the next amount of 125 grand, and then the next, and then the next. So in 4 years, actually 3 years and 1 day, I could probably get 450,000 of that 500,000 in there, and I can put in the last amount 1 day into the 5th year. So that's 4 years and 1 day. But after 3 years and 1 day, most of my money's in there. If this was a whole life policy, it would take me 6 years and 1 day to get that 500,000 in there. It'd take me way longer, okay? And I'd be forced to have way more death benefit than this because the whole life is going to cost me more because of the way it's structured. So I get in the 500,000 and in 3 years and 1 day or 4 years and 1 day. Now, the actual rate of return that I have realized, and many, many thousands of people have realized since 1980, by using Index Universal Life, which started in 1997, in addition to Universal Life, and by rebalancing, the average return has been 9.62. Let's round that down to 9.6. That means your money will double every 7.5 years. Now, in actuality, since indexing came out in 1997, the average return for many people has been about 11.17, netting 10.07. Which means that they're getting credited over 11 and they're netting over 10. That means 1 percentage point is covering the cost of the insurance and all the fees, and the net rate of return is 10. Now that doesn't happen day one when you only have it 20% funded. But once you get the money in there and it starts growing, watch what happens. If you're doing this for living benefits, you want to self-insure. You put in $500,000 and you want that $500,000 of cash to be part of the death benefit, the level death benefit. Why? Because I don't want to be charged any more than the net amount at risk. I want the $500,000 to grow, so I don't want to be charged for $1 million of life insurance every year I get older. I want my insurance to become cheaper as I get older. How do you do that? Even though you're getting older, the cost per thousand goes up, but the amount of coverage, the amount of thousands that you're paying for is cut in half as soon as you get this in here. They're only charging you for the difference between your cash and the original death benefit. They're only charging you, this is the spigot on the bucket, the cost of the insurance, which by the way is watering a money tree that's going to blossom when you die and transfer a bunch of money tax-free. It's not really a cost, it's a benefit. But looking at it for rate of return, the insurance company, when I have 500 grand of cash value, is only charging me for the difference of 500,000 net amount at risk. So even though I'm older, the cost of the insurance is half. They're only charging me for half as much insurance as they did 5 years earlier. When that 500,000 at 9.6 doubles to $1 million in 7.5 years, now I'm, let's say 12.5 years into owning this, that 500 grand has doubled to $1 million. Well, how much are they charging me for now? Technically, nothing. I am self-insured in 12.5 years. My cash is $1 million, and it equals the death benefit. So there is no net amount at risk. So the insurance company is not going to charge me anything because they're not at risk for anything if I die. If I die, it leaves behind $1 million and it's tax-free. I did it so that the $1 million will generate, $80,000, $90,000, $100,000 a year of tax-free income. That's why I did it. I didn't do it for the death benefit. I did it for the rate of return. I tweaked the rate of return by having the spigot get cheaper as I got older. Now, technically speaking, under TEFRA and DEFRA, if you weren't taking out the money, that 500 that doubled to $1 million, that $1 million will double in another 7.5 years to $2 million. Now, if you happen to die when you have $2 million of cash value, the death benefit paid out is $2.1 million, $100,000. When you have $1 million of cash in there and the death benefit was $1 million, if you happen to die, the insurance company actually is going to pay out $1,050,000. But they're only going to charge you for $50,000 because TEFRA and DEFRA tax citations say that the death benefit now has to stay ahead of the cash value growth by 5 percentage points, so it doesn't violate the definition of tax-free life insurance. So you can't believe how many insurance agents don't understand what I just explained to you. But see, at the end of the day, if I have an IUL policy and I become self-insured within 12 and a half years or 15 years or 17 years, the cost of insurance now is so negligible because that little 5% cushion, the cost of that is minuscule compared to the interest I'm earning on $2 million of cash value. So if you were to go into the 20th year, the 25th and the 30th year, the internal rate of return, if I was earning 11% that year, the net internal rate of return would be 10.95. The cost of insurance is draining out 0.1%. But I always simplify it. I just go retroactive back to day one, when you were only able to put in the first 100,000, and then you had to take your time to comply with TAMRA. Retroactive back to day one, if you earn 11, you'll probably net around 10. Only one of those percentage points drained out that spigot, retroactive back to day one, to pay for the insurance that the IRS said had to be there in order for it to be tax-free. But hello, I'd rather be earning 11 and net 10 than have to earn 15% in a tax-deferred IRA or 401k to net 10 after paying tax at the end of the day. To earn 15, I've got to take some real big risks in the market. So I'd rather earn 11 and net 10. That 1% is not tax, but if you did anything else with your money, you would likely be paying tax. So, see, I'll take as much insurance as I can get because it's not costing me anything. It's not free, but it's being paid for with a small portion of money that would otherwise go out the window in unnecessary tax if I followed the herd and put my money in traditional IRAs or 401ks. We don't object to insurance benefits. We object to paying for them. I let the government pay for mine. I'll take this death benefit, but frankly, I want to be self-insured. I want my cash value to equal or exceed the death benefit within 12 years or 15 years. So many agents do not understand how to do that. And so then they go, 30 or 40 years from now, that IUL is going to crash and burn. Why? No, it isn't. Not if you structure it this way. Why do you need guarantees in a whole life policy to guarantee you'll have a death benefit when you actually have enough cash that exceeds the death benefit in as little as 12 years? Is this making sense? If you want to learn more about this, I want to gift you a copy of my most recent best-selling book that's been flying off of our warehouse shelves. It's in its 8th printing. It's actually 2 books in one. This one is about 200 pages, 14 chapters with all kinds of charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you turn it over to this one. And this is about 100 pages, 12 chapters with 62 actual client stories. If you want to use both your left brain and right brain, then I recommend you read both of these books. But you can go to Amazon and pay $20 for it. And if you do, thank you. But I'll gift you a copy free. Simply go to laserfund.com, laserfund.com, or click on the link below. And you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I'll pay for the book and I'll fire out a hard copy to you via priority mail. But when you're in there claiming your free copy of this book, check out the audio and video versions if you like to listen and learn or watch and learn. Also check out the free educational webinars we teach on a weekly basis. There's no charge for those. Those are free. You can even schedule an appointment to talk to an IUL specialist who will actually create an illustration for you at no cost or obligation to show you how a properly structured one can perform in your particular set of circumstances. But this is not about me. This is about you. I want Uncle Sam, so to speak, to indirectly pay for your insurance by redirecting otherwise payable tax like I've done for years.